name is Stephen Flynn, and I'm a partner with Andersen Tax here in Vancouver. Well, today I'm going to talk about the different legal entities that Canadians can choose from when investing in the United States. And in particular, we'll talk about the different tax implications and what makes them either advantageous or inappropriate for their investment. There are a wide variety of choices that Canadians have when choosing a legal entity to operate in the United States, anything from LLPs to LLCs to C&S corporations and many more. But what's important to Canadian investors is not only the U.S. tax implications of the choice of legal entity, but how the results are treated for Canadian tax purposes, because it's these differences that can have a big impact on the rate of return and the overall income tax liability. So take, for example, a limited liability company or an LLC. That's a very common legal entity to use for U.S. investors, and it has some U.S. tax advantages. The LLC isn't subject to U.S. tax itself. It allocates its income and its losses to the individual or partners or investors, and they are the ones that pay the U.S. tax. And so it offers the advantage of not only limited liability for the investors, but also an effective one level of taxation in their own hands. And it's a great solution for U.S. resident or U.S. only investors. And you often see situations where Canadians will invest as a minority partner in an LLC, and they'll hear or they'll get advice from their brother-in-law or their cousin or someone that says, well, this is what we use in the US, and so you should do the same thing. And the concern we have is that from a Canadian tax perspective, an LLC is a very different result. Canada doesn't treat LLCs as partnerships or flow-throughs, it treats them as corporations. And so as a result, Canada taxes the cash that's received from the LLC as a dividend, as opposed to the income or gains that are allocated. And so you can often get a result where you have tax in one country, the United States, at one time, and tax in the other country, in Canada, at a different time with different characteristics, and an inability to claim foreign tax credits. And as a result, when you add up the tax liabilities in both countries, it can be well in excess of 50%. And this is the reason that Canadians need to get their own advice and their own tax advice on investing in the United States, because what works for their brother or their cousin in the United States won't necessarily work for them because they're a resident of Canada. In general terms, we discourage Canadians, if they have a choice, from using U.S. limited liability companies or LLCs because there's better choices out there. Now, oftentimes, a Canadian doesn't have a choice. They're a minority partner, they're investing in a syndicate, and the entity's already been formed, and they either have a either invest or don't invest choice. And so when they have to use an LLC, while it's not a perfect solution, we can have some suggestions here. For example, they could have their ownership of the LLC held by a U.S. corporation, which is in turn owned by their Canadian corporation. This can mitigate some of the problems of that double taxation or that timing issue. The downside of that is that there's an expense of forming two more entities and the expense of running that. Alternatively, if they can at least try and time the income each year to match the cash distributions they receive, it can go a long way to mitigate or reduce that higher tax liability than expected. And finally, on an exit or a sale of the investment, if they can sell their shares in the LLC as opposed to having the LLC sell its assets and then distribute cash, that can also minimize the adverse Canadian tax consequences of investing in an LLC. In conclusion, if you have a choice, Canadians should be discouraged from using limited liability companies. However, when there is no choice, there are some solutions that can be used to at least mitigate some of the higher tax liabilities that will result. Limited partnerships in the United States are a common way for Canadians to invest in the United States. Unlike LLCs, a limited partnership is treated as a flow-through entity for Canadian tax purposes. And so as a result, the income or losses and any capital gain on a sale of the property would be subject to the same treatment in Canada at the same time, resulting in a much more effective tax rate between both countries. You often see limited partnerships used in real estate investments by Canadians in the United States. The U.S. has a number of different types of partnerships, everything from a general partnership to an LP or a limited partnership to an LLP or a limited liability partnership, and you see those often in professional services situations. Or what's fairly new is an LLLP or a limited liability limited partnership. And they're not all treated the same for Canadian tax purposes. So we talked a bit about LLCs and the pitfalls for Canadians that use them. In our next segment, we'll talk about the different types of U.S. partnerships and how Canadians can use those to invest in the United States. Canada has treated LLPs and LLLPs as corporations for Canadian tax purposes, and so the use of an LLP or an LLLP by a Canadian gives you the same adverse tax results that we talked about before using LLCs. Canadians should be using limited partnerships as opposed to LLPs or LLLPs. The downside of using a limited partnership is that there has to be a separate entity alongside it, usually a corporation that sits as the general partner. It's a small price to pay to ensure that the Canadian tax results are consistent with the US tax results, with your overall tax being far lower than if you used an LLLP or an LLP. Well, in December 2017, the US passed sweeping tax legislation changes that lowered the US federal corporate rate from an average rate of about 35% all the way down to a flat rate of 21%. And as a result, the use of regular US corporations, called C corporations, has become far more attractive for Canadians to invest in the United States than it was before. Another choice of entity is called a US S corporation. And this is a corporation formed under US law that makes a certain election to be treated as a flow-through entity for US tax purposes. You don't see this type of entity commonly used by Canadians because under US tax law, an S corporation has to have all of its members be US persons, in general being a US citizen resident in Canada. And so for Canadians, they would have to first be US citizens to use this entity and then have a reason to do so. You'll often see this type of entity used when a Canadian resident who's a US citizen invests in US businesses, sometimes a US real estate project, and they can make a choice or an election under the Canada-US Income Tax Treaty to treat, for Canadian tax purposes, any income or losses the same way as it's treated for US tax purposes. So the use of the S corporation and making the proper election under the Canada-US Income Tax Treaty will allow the income to be treated the same way in Canada as it is for the United States and effectively be treated as a limited partnership, resulting in the overall Canadian-US tax liability to be similar to what you would have expected using a limited partnership. One of the concepts under US tax law that's very different than Canadian tax law is how income is treated in the investor's hands. Under Canadian tax law, in general terms, we like to use corporations and have the income and gains taxed in the corporation, and then we get a choice when and how to pay that or distribute that to the shareholders. In general terms for entrepreneurs, under US tax law, we use something called flow-through entities, which means that the entity itself isn't subject to tax, but it allocates the income and expenses to the investors themselves to be taxed as one level of taxation. So there's a very distinct difference between the two countries, and when a Canadian is investing in the United States, we want to take those same advantages that you see in the United States with flow-through entities and have the same things happen in Canada so that we can time our taxes, claim our foreign tax credits, and ensure that we're not paying tax twice on the same income. But US entities, while they'll flow through in the US, aren't all necessarily flow-through entities in Canada. And it's those differences that we have to watch for when we're recommending choices. Oftentimes, Canadians don't necessarily need to form a US entity to do business with or in the United States. We'll often see this with consultants who do the majority of their work in Canada for US clients, but infrequently travel to the United States to perhaps meet with those clients or attend conferences. And in general terms, they can take advantage of provisions under the Canada-US Income Tax Treaty to not pay US federal income tax on the income they have with their US clients or even when they're physically in the United States. And so as a result, they don't need to go through the complexity and the cost of operating a separate US entity. They can just continue to use their current Canadian corporation to conduct their business in the United States. They'd still need to file a US tax return to notify the IRS of their intentions. So in summary, the choice of legal entity to use when investing in the United States depends on a number of factors. Everything from the individual's status in Canada to who their partners are, either in Canada or the United States, to the type of industry they're in, to the level of activity they'll have physically in the United States, even to their exit strategy as they sell the business. All those factors we take into account when recommending the proper US entity to use for Canadian investing in the United States.